Hey guys, Chris Elliott over at RE/MAX Action Real Estate with your November 2020 market update. Super excited to be delivering this information to you guys. I've got to address something from the start. We've been hearing a lot lately. I've heard buyers talking about it. I've heard sellers talking about it. I feel like I've heard people on YouTube talking about it, that we've got this impending 2020 market crash. It's inevitable. It's coming. A lot of people are talking this because prices continue to rise or the election or whatever. So we want to address this head on, looking at the actual data. So if we look at the data, the number of people that are on mortgage forbearance is actually dropping dramatically. A lot of folks have come off the initial forbearance period and decided not to extend or not to elect to go into another forbearance period. What we also know doesn't necessarily show on this graphic, but that a lot of folks that actually took the forbearance option continued to pay their mortgage. They just took that forbearance because banks made it very readily accessible. A lot of people took it as a safety net, but we know a lot of those folks continue to pay their mortgage. So something important to know. Also something important to know, if you look at the graphic, that we are at historic low numbers of distressed sales. We're about 1% of every home that's selling is a distressed sale. So even if we tick up a little bit, we're still at historically low number of distressed sales. The other thing that we got to look at, looking at this equity slide, and we've showed this to you in the past, U.S. homeowners are sitting on a lot more equity now than they were back in the run-up to 2008. Roughly 93% of homeowners right now, if they got themselves into a pinch, could afford to hire a real estate professional, sell that home, still walk away with a couple bucks and move on down the road. So despite what the YouTubers are saying, despite what your coworker may say at the water cooler or on the Zoom meeting or whatever, the facts just show that we're not headed into another foreclosure crisis, that we're not even headed into a bad market. In fact, Ivy Zelman, a very respected economist, said there's literally a 0% chance of us heading into another foreclosure crisis. We might see a small uptick of more foreclosure sales as the economic impacts of COVID hit some homeowners, but once again, 0% of another foreclosure crisis. So what are the problems we are actually facing in the real estate market? The number one problem that we're facing is a lack of inventory. As you can see in this graphic, we're at a nationwide level of 2.7 months supply of inventory. A balanced market is 6 months supply of inventory. Anything above 6 months is considered a buyer's market. We're at historic low month supply of inventory levels, which just means there are more homeowners out there looking to buy homes than there are homes to actually sell them. We had this problem going into the pandemic, but it was exacerbated by COVID because you had a lot of folks that just didn't feel safe or felt uncertain about the future putting their home on the market. So that continues to be the problem. If we look at this graphic, you'll see year-over-year listings. The green line is the number of new listings. As you can see, we're constantly at a lower state than we were at the beginning of this year, but the orange line is actually the amount of overall available listings, new and existing, and that number just keeps going down and down and down. So the problem of this year, probably going to be the problem next year too, is just a continued lack of inventory. It's a good thing for homeowners though, because due to simple supply and demand economics, you've got a high demand with low interest rates and buyers just out there looking to buy, very low supply. Homes have continued to appreciate and are projected to continue to appreciate going into next year. So once again, if a coworker or you see a YouTube video or something like that says we're heading for a crisis, that is not what the data shows. It is not what the experts are predicting. You can see Zillow is very bullish on what they project. They're saying we're going to see 7% appreciation rates. There's other organizations like Ivy Zelman, the Mortgage Bankers Association, the National Association of Realtors. They're projecting that we're going to be closer to about 5% appreciation next year. So very, very good news for homeowners. Interesting enough, though, something to keep in mind, Jeff Tucker of the chief economist at Zillow pointed out a very good point. With homes continuing to appreciate and also interest rates projected to tick up slightly in the next couple of years as the economy gets better, that can erode some of the affordability that we're seeing right now. So homes, if you look at the affordability index, homes are very, very affordable right now, even though the prices continue to go up because mortgage rates are at such low historic rates. Even if you're paying a higher price with a lower mortgage rates, super, super affordable. But we could see some of that going away, some of that affordability going away as prices continue to rise, as mortgage rates rise a little bit as well. This graphic just shows you the Mortgage Bankers Association of interest rates projected to climb at about 0.3%, or roughly a third of a point over the next 3 years. Just once again, as the economy improves, they're going to start raising mortgage interest rates and be able to afford to do so. If you talk to anybody with a little gray hair, even at 3.9, 4, even 5%, that's still an historically good mortgage interest rate. But obviously it's just something to think about if you're somebody that's just saying, hey, I'm going to sit on the sidelines and wait till prices come down, which they're not projected to do, or I'm going to wait till things are a little bit more certain. You can certainly do so. It just might cost you more to do so. So something to think about. And then last but not least, we already talked about the affordability, but that's just a good quote from Mark Fleming, the chief economist of First American. So what does this all mean to you? For our sellers, we're telling them, hey, an upsized move will most likely be more expensive the longer you wait. So we already talked about that. If you're somebody that's looking to sell and then buy bigger, understand that home, while your home's going to continue to appreciate, if you're looking to buy a more expensive home, that home's going to appreciate that much more. And then with interest rates being a little bit more in the years to come, waiting on the sidelines could cost you more money if you're waiting for things to be more certain, or if you're just hoping that prices comes down, or interest rates stay at the current rates. There's also still time to sell before the end of this year. What we know this time of year, I'm shooting this on November the 11th, anybody buying a home right now is looking to get in that home by the end of the year. So if you've been putting it off, or you're thinking about a move, realize there's still time to get that done before the end of the year. Even if we list on December 1, there's an opportunity to close that sale out by the end of the month, or sell the home and then schedule the closing for January if you'd like to stay in the home during the holiday season, or not be bothered with the move during the holiday season. If you're somebody that's thinking about making a move next year, now is a super good time for us to get together before the holidays start and really just sit down and put together a game plan. What we know is most all homes, or most of all appointments we go on, there's always a couple things to do to the home to get it to the most saleable state, or to net the most amount of money. If we can have that conversation now, you'll have that list, you'll have that game plan of things that you can execute on, while you've got some time off of work, while you're spending more time at home over the winter, and that way you're not starting flat-footed in January, which is what most people do, and then they're not listing until February or March, where there's more inventory that they're competing with. So something to think about if you know moves in your future, definitely in 2021. For buyers, man, it's been a tough year. You've had to compete on every single listing. There's been very few homes to choose from. And man, it's just been tough for buyers out there. But I will tell you, don't let that fatigue take you out of the market. As we're seeing, mortgage rates are projected to continue to rise. And prices are expected to go up. So those two things together is going to make housing a little bit less more affordable the longer you wait. So I would say stay in there. Keep fighting it out, keep duking it out, because if you can get a home under contract right now, you're going to lock in a tremendous interest rate, and you're going to lock in a price that is likely to be higher in the future. So something to think about. And along those lines, compare overpaying to appreciation and rising interest rates. So we're talking to a lot of buyers that are like, man, I'm overpaying. My wife and I have a home under contract. We're arguably overpaying for it right now. But what we know is that prices will continue to rise, interest rates will continue to rise. So even if you're overpaying right now, you might look back and be very happy at the deal you struck right now versus waiting till quote unquote prices comes down. And then last piece, I'll leave you with a little bit of hope. We are projected to see a little bit more inventory, not a tremendous amount more, but we're expected to see a little bit more inventory next year from a lot of folks that maybe thought about selling this year and just pushed it off till 2021, in hopes for a vaccine or just a little more for financial certainty. So hope this information finds you guys well. Appreciate you staying tuned in. Hope you have a great month of November. We'll look forward to seeing you next month.